price naturally gravitates toward areas rich in liquidity, and once that liquidity is absorbed, it often moves away from those levels. Recognizing when liquidity is being taken, particularly before price approaches a prime trading zone, adds an extra layer of confirmation to our analysis. These zones can also lead to sharp rejections, so it's smart to lock in partial profits before price touches them. The final step is spotting fair value gaps and order blocks, our main trading zones. A fair value gap is the void between the wicks of 3 consecutive candles on the price chart. The candle responsible for forming this gap is also marked as an order block, since it reflects the moment significant market decisions were made. This zone highlights a buy-side imbalance, where aggressive buying overwhelms selling, often signaling institutional involvement. When price moves through this inefficient phase, it generally returns to the fair value gap area to patch or fill it. For safer entries, wait until price re-enters the order block zone before initiating a position. For even greater precision, zoom into lower time frames, watch for reversal confirmations, and then execute your trade. We'll explore that next. The final step in this trading plan is to drop down to the lower time frame, wait for confirmation signals, and then execute the trade with precision. After the price enters our trading zone, we look for confirmation that the short-term downtrend has ended and the market may be ready to move upward. To identify this potential reversal, we focus on liquidity sweep patterns and changes in character. A valid liquidity sweep below the recent low often signals a possible shift in direction, and if the price breaks above the recent high, we consider it a confirmed change of character. Once this reversal is validated, we move forward with the trade setup. We wait for the market to form a new order block. This is the foundation of the order block within an order block strategy. It's important to note that this lower time frame order block doesn't have to be located inside the higher time frame order block zone. After identifying the order block on the lower time frame, we place a buy limit order at the beginning of the order block and set our stop loss just below it. For trade management, we secure partial profits and move the trade to break even once we reach a 1 to 2 risk to reward target. The next target will be the nearest key zone on the higher time frame. Before jumping into real chart examples, let's first go over a few common chart scenarios and how to navigate them. Would you like a visual diagram for this strategy setup? In the first scenario, where the order block zone is very narrow, it's advisable to use a slightly larger zone for your stop loss placement. The reason is simple. Tighter zones are more vulnerable to minor market fluctuations and stop hunts. By widening your stop loss, while still keeping it logically placed just beyond the structure, you give your trade a higher chance of survival, allowing the market some room to breathe without prematurely taking you out. In contrast, when there's a sizable order block zone on a lower time frame, the challenge is that placing our stop beneath this zone results in a wide stop loss. To manage this, we can either use a smaller zone just below the order block as our stop, or position our entry around the midpoint of the zone. This method can greatly enhance our risk-to-reward ratio if the trade goes in our favor. In the third and most crucial scenario, we identify several order blocks before price reaches our target. We'll trade each valid order block the market creates along the path, as long as they present favorable risk-to-reward setups. These entries will be taken with minimized risk exposure, so avoid placing trades that risk over 2% of your capital, and never maintain more than 3 open positions at once. Keep in mind, our main goal is to close the day in profit. Missed opportunities and losses are part of the process. After conducting backtests on this strategy using the euro-dollar pair during the London and New York sessions, we've observed numerous recurring market behaviors. Although this isn't a real-time chart example, it reflects typical market movements and our response strategy. On the 1-hour chart, we can clearly see a steady upward trend, so our bias remains on the buy side. The most recent price action has produced several fair value gaps, so we highlight the candle preceding the imbalance as our key trading zone. The main concept is to wait for the price to revisit this zone, then switch to lower time frames to seek confirmations before executing long entries. But before proceeding, let's review the higher time frame to ensure our analysis is in line with the overall market direction. On the daily chart, it's evident that the market has recently pushed above a key resistance zone, signaling strong bullish momentum. Moreover, there's still considerable room for price to move before hitting the next major level above. This confirms that our 1-hour chart outlook is in agreement with the daily time frame. Now returning to the 1-hour chart, as mentioned earlier, we must wait for a retracement into the order block zone, and then shift to the lower time frames to identify signs confirming a bullish reversal before entering. So let's switch to the 5-minute chart. On the 5-minute, the market has already shown a change of character, which serves as the reversal cue we were waiting for. This suggests that the short-term bearish trend has ended, and we can now confidently look for long setups. The next step is to wait for price to establish order blocks and execute long entries. Here, we see an order block formed, so we initiate a long trade. As the market continues upward, another order block is created. Without closing the first position, we place a second long trade at this new zone. This strategy is crucial because price may skip the initial order block and only revisit the second one before moving higher. In the worst-case scenario, price could decline and trigger losses on both trades, which is why maintaining reduced risk per entry is essential. Now let's observe what unfolds. Price hits the stop loss on the second trade while the first trade remains active. Once again, we identify a fresh order block, and without closing the existing position, we place another long trade at this new zone. We repeat this method until price reaches our target, which aligns with the previous high on the higher time frame. While this strategy has shown consistent profitability, it's essential that you carry out your own backtesting before risking actual capital. This is the reality of trading. Even with a solid plan, you'll face losing trades. That doesn't always imply your analysis was flawed. The most important takeaway is to document your trading rules and stick to them. If you continue to follow your risk management strategy, you'll stay on the right track. So that wraps up today's video. I hope it brought value to your trading journey. If it did, make sure to hit the like button to show your support, and if you're new, don't forget to subscribe to the channel. Catch you in the next one.